What if I told you that the recent chaos in the silver market is not about silver at all? Not really. What you're watching is a stress signature, a visible fracture forming in a system that has relied on trust for far too long. Markets don't break when the math stops working. They break when psychology overrides probability. And that's exactly what's happening now. Why volatility is the signal, not the story. Most people see volatility and assume speculation. They assume greed. They assume a bubble. But that's a surface level interpretation. Volatility is not random. Volatility is a response. It assudes what happens when a system is forced to reconcile two incompatible realities at the same time. On one side, you have a paper-based market, futures contracts, ETFs, derivatives layered on derivatives. On the other side, you have physical reality, finite metal, industrial demand, custody, access. In calm periods, those two worlds are treated as interchangeable. Under stress, they diverge violently. The paper-physical schism. In theory, every paper claim on silver represents real metal. In practice, it never could. The system only functions as long as most participants never ask for delivery. That's not a conspiracy. That's how leverage works. But once stress enters the system, once trust weakens, the question changes. Not what's the price, but can I actually get it? And that's when spreads widen. Premiums spike. Delivery delays appear, not because silver vanished overnight, but because the illusion of abundance did. Why psychology beats math in market crises. Here's the uncomfortable truth. Markets don't fail rationally, they fail emotionally. Fear compresses time horizons, desperation overrides models, and probability gets replaced with survival behavior. In those moments, participants stop asking, what is this worth? And start asking, what happens if I'm wrong? That shift is deadly to paper systems, because paper depends on confidence, physical depends on existence. Institutional behavior. Is the real forget retail traders, forget headlines, forget social media narratives. The real signal is institutional behavior. Quiet, methodical, unannounced. Banks and large entities are not chasing price. They're securing custody. They are reducing counterparty exposure. They are choosing possession over promises. This is not speculation. This is insurance positioning. When institutions move this way, they are not trying to make money. They are trying not to lose control. And every ounce they remove from circulation makes the remaining system more fragile. Liquidity is disappearing where it matters most. Here's the paradox. Markets look liquid until they aren't. Paper liquidity can expand infinitely. Physical liquidity cannot. When physical metal is withdrawn into private custody, it doesn't come back easily. That shrinks the float, increases sensitivity, and amplifies every shock. The paper market becomes louder, more volatile, more reactive, because it's trying to price something it no longer controls. Geopolitics changed the rules of ownership. Now let's talk about Venezuela, not politically, structurally. The seizure of assets was not just a political act, it was a precedent. It sent a global message. Ownership is conditional. Access can be revoked. Assets can be weaponized. That changes how risk is calculated. Because if ownership depends on alignment, then paper claims depend on power structures, not law. And once that realization spreads, trust evaporates quickly. Why physical assets regain importance. In a world where access is political, physical possession becomes strategic, not because it yields more, but because it cannot be frozen, cannot be canceled, cannot be digitally nullified. This is not about return on investment. It's about return of certainty. Silver sits uniquely at the center of this shift. Silver's dual nature makes it unstable and revealing. Silver is not just a hedge, and it's not just an industrial input. It's both. That makes it incredibly sensitive during systemic stress. When trust erodes, monetary demand increases. When supply chains tighten, industrial demand accelerates. Those two forces normally move separately. During crises, they activate together, and when they collide, you get violent, erratic price behavior, not because the market is broken, but because it's being recalibrated. Liquidity stress is the invisible backdrop. Now zoom out. Repeated liquidity injections, emergency funding operations, repo stress. These are not signs of stability. They are signs of dependence. A system that must be continuously supported is a system that participants quietly plan around. Paper assets require trust and continuity. Physical assets require no explanation. When liquidity becomes a policy decision rather than a market function, risk is repriced. Markets are now on edge. This is the most important concept to understand. We are in a regime where small shocks create oversized reactions. Why? Because multiple pressures are interacting simultaneously. Physical supply constraints, financial fragility, geopolitical leverage, information distortion. This creates a condition where the system probes itself. Stress tests emerge organically. Silver is one of those probes. Volatility is not chaos. It's adaptation. What looks like chaos is actually adjustment. The system is relearning how to price. Custody, access, control, trust. Price alone is no longer sufficient. That's why volatility clusters. Why moves overshoot. Why reversals are violent. The market is no longer smooth. It's adaptive. What this really means: silver is not leading the crisis. It's reflecting it, like a warning light on a dashboard. You don't blame the light, you ask why it turned on. And what it's telling you is simple. The era of assumed trust is ending. We are entering a period of conditional trust, fragmentation, strategic assets, and in that world, physical reality is repriced above financial convenience. This is not a call to panic, it's a call to awareness. Because understanding stress is how you navigate transition. Because stress doesn't just move prices, it reveals hierarchy. Why prediction fails in transitional markets. One of the biggest mistakes people make in moments like this is trying to predict price, up or down, targets, timelines. But prediction assumes stability, and stability is exactly what's missing. In transitional environments, direction matters less than structure. The market isn't asking, where should silver trade? It's asking, who controls access? That's a fundamentally different question, and it renders most traditional analysis incomplete. Control replaces price as the key variable. In a healthy market, price balances supply and demand. In a stressed market, control overrides price. Who controls inventory? Who controls settlement? Who controls liquidity? When those controls become uncertain, price becomes reactive, not informative. That's why charts feel erratic. That's why correlations break. That's why shouldn't be happening keeps happening. The system is repricing who holds power, not just ounces. Why paper markets become noisy. Under stress, paper markets are designed for efficiency, not resilience. They function beautifully when trust is assumed. They struggle when trust is questioned. Under stress, paper markets do one thing extremely well. They transmit fear faster than reality. That creates noise, violence, overshoots. But noise is not the same as signal, and confusing the two leads to the worst decisions. The most dangerous mistake, confusing motion with meaning. Large price moves feel meaningful. They feel urgent. They demand reaction. But motion does not equal truth. In fact, the louder the move, the more likely it's masking something quieter, like physical withdrawals, inventory shifts, custody transfers. Those don't make headlines, but they reshape markets permanently. Why institutions don't explain themselves. Here's another key insight. Institutions don't announce structural decisions. They execute them. By the time you hear justification, the positioning already happened. That's why watching behavior matters more than listening to narratives. Paper volatility screams. Physical movement whispers. And right now, the whispers are constant. Silver is a custody signal. Silver's recent behavior is not unique because it's silver. It's unique because silver sits at a crossroads. It's small enough to stress easily, critical enough to matter, and liquid enough to reflect pressure early. That makes it a custody signal. When silver shows strain, it's telling you something about trust, about leverage, about limits, not just in metals, but across the financial architecture. Why information itself becomes weaponized. In unstable systems, information becomes a weapon. Extreme narratives thrive. False certainty spreads. Emotion outruns analysis. AI amplification accelerates this. The goal isn't accuracy, it's influence. That's why disciplined awareness matters more than ever. Not reacting, not predicting, but observing structure. How disciplined awareness actually works. Disciplined awareness is not passive. It's intentional. It means asking better questions, like what is being removed from circulation? Who is gaining custody? Where are bottlenecks forming? What actions are irreversible? Price moves are reversible. Custody changes are not. Liquidity injections can be unwound. Physical withdrawals cannot. Why volatility will persist. If you're waiting for calm, you may be waiting a long time. Volatility is now a feature of transition, not a temporary glitch. As systems fragment, as trust becomes conditional, as access becomes strategic, markets will remain reactive, not because they're broken, but because they're adapting. The silent repricing of trust. The most important repricing happening right now is not silver, not gold, not currencies. It's trust. Trust in settlement, trust in ownership, trust in continuity. Once trust is questioned, it never returns to previous levels. It resets lower, and systems reorganize around that new baseline. Why this isn't about winning or losing. This isn't a story about beating markets, or timing trades, or calling tops and bottoms. It's about understanding which rules still apply, and which no longer do. Paper convenience is being repriced lower. Physical control is being repriced higher. That's not ideological, it's mechanical. What silver is ultimately signaling silver is not predicting collapse. It's signaling transition, from integration to fragmentation, from assumption to verification, from promises to possession. It's not the destination, it's the indicator, like pressure building behind a fault line. Final thought. You don't need to fear this environment, but you do need to respect it. Because systems under stress don't fail loudly at first. They reveal themselves quietly through behavior, through withdrawal, through subtle shifts in priority. Silver is one of those signals. Not because it's special, but because it's honest. It reflects physical reality when narratives break. And in a world where trust is conditional, reality always wins. This is not a call to action. It's a call to understanding. Because the people who navigate transitions successfully are not the ones who predict outcomes. They're the ones who recognize structural change early and stop playing by rules that no longer exist.